For episode 16, I sat down with Callie Cox, the Chief Market Strategist at Ritholtz Wealth Management. Callie is one of the rising stars in our industry, and her work has been featured on CNBC, Bloomberg, and the Financial Times. We started the conversation around the idea of a money story and how much these stories shape us and how we make decisions. We also discussed Callie's career path as a woman in finance, younger investors, the Millennial Experience, and how finance evolves with each generation. Thanks again to Callie for a great conversation, and we hope you enjoy this episode. All right, so Callie Cox, it's so great to have you here on the Alliance Wealth Advisors podcast. Been a pleasure getting to know you a little bit here these last few weeks, but I think before introducing you fully to our listeners, maybe we could start with the new role you just took on, and you can tell listeners who maybe aren't familiar with Ritholtz or familiar with your work, sort of what you're doing there and how you'll be spending your time in the new job.
Yeah, well, it's great to be here, Mike. I'm so excited to chat with you. I know we have some really good conversation topics coming. So the big news out of my front is that I'm at Ritholtz, which I'm biased now, but I think it's one of the best RIAs in the world at doing right by their clients. Ritholtz, of course, is the firm that Josh Brown and Barry Ritholtz started. Barry's the namesake, and I'm the chief market strategist there. So I'll primarily be responsible for creating content for advisors, that timely market content that becomes really important when markets are moving quickly or there's a geopolitical headline or a big Fed decision, and the more evergreen content, helping advisors and by extension, their clients understand how markets work, understand how their brains work when it comes to investing, understand how different aspects of financial planning interweave with markets. My career has basically been talking markets in different, spheres, really. I was a journalist first, and, now I've been in research for over a decade. And, this is just another sphere to me. I think it's such an interesting challenge to, teach advisors, but teach them to be financial superheroes for their clients. And Ritholtz's advisors are already there. They are already financial superheroes. I'm just another tool in their belt.
So as I fix my wire on camera here, so the for listeners who maybe don't know Callie, she actually made this announcement for her new job last week on CNBC, and now she's here with us. So we're happy to have you for that reason too. But I think when we started following your work at Alliance, I think what was attractive to me and to the rest of our team was that you have written so many pieces, I think, that are about complex topics, and you have a knack for simplifying them. And I think one thing we share and had hit off on in our initial conversation or our introduction was just like how that seems to be really hard for our industry. And so how did that become, I guess, something that interested you or something that was important to you to do?
It's my background, first of all. I don't know how many listeners know, but I actually went to journalism school. I'm not the traditional B school, econ degree, PhD, coming into this industry and talking about, the Bank of England and why rate cuts affect, high yield debt. I was never like that. I started out as the person asking the questions. And, back then I was really torn about being a reporter. You go to J school, you go to journalism school, you come out. Most people become reporters or they move into PR and marketing. I was good at writing, so I figured my path would be a reporter. And I was fortunate enough to land my first job as an options reporter at Bloomberg. So I was a journalist at Bloomberg. I was writing about markets, specifically options markets, but I knew that I didn't want to be a reporter long term. That's just not, it wasn't the skill set I had. I liked talking about numbers and analyzing numbers, but I didn't love the sourcing, the going out and reporting. I already knew that traditional reporting wasn't what I do. I just don't have, frankly, the guts to do it because it's a hard, grinding job to be a reporter. Yeah. So I figured I wanted to tell the story instead of asking other people what the story was, but I had to learn about the industry. And I actually had a good group of strategists who taught me about markets, and they did so through storytelling. Because quite frankly, that's the best way to learn.
Yeah.
That's what every human connects with. So I always dreamed of becoming a strategist, but one that really connected with the everyday investor. And I'm fortunate enough to be here. I've built a brand on that, and I'm excited to take it to a firm that does the storytelling thing best.
Yeah, they do. That's for sure. So, one of the pieces you wrote was published back in 2021, which was called "My Money Story." So, I want to talk about that as a way to go back and tell your not only your career but your sort of life story coming up, because it's something we talk about all the time with our clients. Right? It's um, how does money impact us? How do those early experiences impact us? So, first of all, maybe just give a brief background of like what you would deem a money story, so to speak, and then what's yours.
Yeah, and I love that you asked this question. This is the type of question that if you asked me during a happy hour, I could go down a rabbit hole for hours. And I love that you ask your clients about this too, because I think it's so important. But a money story to me is just reconciling with your early memories of money. When did you first learn about money? What are the emotions around money for you? How have they stuck through you getting older, going into adulthood, finally managing your own finances? It really is just being honest with yourself about money and what it does for you. And of course, you can take a bunch of different tangents with that. You can talk about what's enough for you and why, what your goals are and why they are your goals. It's the root of all these discussions that we have about markets and investing and money. I truly believe that. So my money story, and I'll be honest, this was a selfish endeavor for me. I have kind of a complicated background when it comes to money. I grew up as one of six kids in a family where my mom was, a traditional homemaker. She had part-time jobs here and there, but it wasn't really much. My dad owned his own business. He was a commercial and residential electrician, and money was always tight for us. Um, I had a lot of great memories from my childhood, but a lot of the memories I have were colored by this fact that I didn't have as much as my friends. I sometimes was wondering, about my next meal and where it was coming from. It was that stressor that kind of tainted my childhood, and otherwise great childhood, by the way. I can't throw enough respect to my parents because raising a family of six kids is an incredible feat. But I really wanted to dive into that as I got older because I noticed these moments where my feelings and experiences around money would kind of bubble up in my life. So great example of that is to this day when I get takeout, I still get this funny feeling in my belly because and it doesn't make sense on a spreadsheet, but because takeout was always kind of a luxury or going out was always a luxury for
Yeah.
us. And my first understanding of it was this is a special occasion, but it's also one where we stretch the budget a little bit. And it's
Wow.
so funny because my whole job is talking to people about money markets and investing, but I struggle with these types of emotional experiences too. So, I mean, my money story is basically like my career. Getting into money was something I did because I was always obsessed with money. I was always obsessed with how other people had it, why I didn't, and how I could eventually close that gap. And that's the main reason I'm working in finance now.
I think I can relate to a lot of that. So I was one of five, and my mom stayed home with us while we were, growing up for the most part, and then she went back to work. But it's funny what about that money story idea. You also take on your parents and the people who raise you and who you're around. You take on their stories to a certain degree too, without even noticing it. And what was interesting is uh, my dad was one of three, my mom was one of 14, right? And just very different. And so you're sort of blending these things that are being taught to you, whether they're direct or indirect, and absorbing them in a way. And a lot of the times we'll talk with clients and they're not even sort of aware. They know that feeling you were mentioning with like the takeout is there, whatever their thing is, but they're not 100% sure why. And then when you crack it open, they're like, wow, huh, well, that's interesting.
Isn't it? It is so interesting to me. And I just finally got to a point in my career. funny enough, it was during COVID. Maybe I had a lot of time to think, but I got to a point in my career where I realized that this was a big root of how I thought about money. And is still coloring my life when it comes to my work and my personal finances and my investing strategy. Like, I'm probably a little more on the conservative side just because I worry about losing it all.
Yeah.
I'm a crazy saver. My husband and I are. And I mean, it's not because it's prudent necessarily. It's more because, I worry that that money will soon leave me. It's an irrational worry, but I know now through years of therapy that that's rooted in my childhood and the experiences I had growing up.
I think what's really interesting and important about that comment or that thought is like you're not trying to build sort of that spreadsheeted plan out to be completely efficient, right? Like you're creating a buffer and building a plan around the way you think versus trying to make yourself be someone who you're not. And
Mhm.
when you can financial plan for people in that way, that's when people really buy into the process. Do you agree with that?
Yeah, I completely agree because we're all human, right? We're not robots. Robots work well with spreadsheets. AI works well with spreadsheets. We are complex humans with lots of emotions and experience to lean back on. And that's how you should approach a financial plan, frankly.
Yeah.
I think a lot of financial advisors do a really good job at this. First sitting down and understanding, why people think that the way that they do around money and getting on the same level as them, saying like, "This is my experience too, and, this is how I work that into my financial plan." Not necessarily saying you need to do the same, but, understanding that we're all human here and that there are these roots that you have to dig up. Otherwise, you won't be successful with your financial plan because these feelings will kind of eat at you while you're following the spreadsheet, and you're miserable, and then you end up not meeting your financial goals. So frankly, I think a lot more people in the industry need to talk about this. I think Wall Street sometimes falls into this hole of trying to be like holier than thou, saying this is where markets are going, and trust me, I'm a strategist. I've got it all together. And the truth is, none of us have it all together. We're all dealing with these same currents from our money stories. So I love that you shared that, and I think people need to share more about it.
Yeah, completely agree. So transitioning back to your career path a little bit, you had mentioned so you're at Bloomberg, you're covering the options markets. And what did the path look like? Like what was the evolution to get to this role you're in today, which seems like it's sort of almost made for you. But I'm sure it wasn't a straight line. It never is. So talk to listeners a little bit about what that looked like for you and how you made those decisions to get to where you're sitting today.
Well, first, I want to be clear. I was an options reporter at Bloomberg, but I took that job because I needed a job. I, I took it not knowing what a put or call was,
Wow. So that was
but
your
being
first job,
completely
like
open.
right out of graduation.
Yeah, so the way that that went down was I got a news internship with Bloomberg. They hired about 10% of the interns from the program, so I think it was 2 of 20. Excuse me, 3 of 20, so a little higher than 10%. So anyway, the point is not a lot of us got jobs, and the few that did were hired as rotational reporters, which means that we weren't put in a beat right off the bat. We didn't have something we covered. We basically rotated desks. My first desk was corporate finance, so I learned about the world of bonds, which was really interesting. And my second desk was the stocks desk. I interned on the tech desk, but the point of the program is we want to get you exposure to all these desks.
It's
So
an
you,
amazing first job.
um,
In
oh, it
terms
was
of
great.
yeah.
I learned a lot. But the catch is once you were done rotating, you had to find a job. And, newsrooms, as you know, aren't getting bigger. So it's usually like a one in, one out type of deal. So there was an opening for an options reporter job. I really wanted to be on the desk. I loved the energy of it. And the way to do that was to become the options reporter. So that's how I became the options reporter. And what I did as part of that job is I essentially wrote research for Bloomberg clients. I wrote this daily options column on differences in implied volatilities on stocks and ETFs and indexes that clients could look at and say, oh, wow, that's an interesting trade. And I would interview strategists and traders from around the industry on what's going on, what's the story behind it. I wrote some stock stories too, but that was my main role as a reporter. So I'm telling you this because what I did right off the bat was research. It was the furthest thing from journalism. And it turns out I liked it. So I got to a point where I was confident enough in what I could do that I made the transition to research. And at the time, I was also in New York. So, and I knew I wanted to be in North Carolina where I grew up. So I figured, if I'm changing careers, I might as well change locations too. Uh,
Let's get it all
so
done
I
in one
started,
shot.
I know, right? Just rip the band aid off. So I worked for a small firm called Tab Group. It was Larry Tabb's, TABB, his research firm. It covered market structure around, stocks, bonds, and options. Basically, where you trade something, not necessarily what you trade, where you trade and how you trade it. And I really loved it, but I wanted to get back into equity research. So I took a stint at a bank. I was in Raleigh, and there was a point where I knew that it was right to switch jobs, but being in Raleigh, North Carolina, there isn't a lot of finance. So I took a job at a bank as a treasury analyst and really worked on my skills in Excel there. Learned about how money works, how the sausage is made at banks. And then eventually my husband and I wanted to move to Charlotte. So I got into equity research. Ryan Dietrich is a good friend of mine and actually introduced me to the team at LPL, one of the best research teams in the industry, but I'm a little biased too. And I started in equity research there. And from there, the path was quite clear. And all this time, too, I was writing online. I was putting myself out there to better understand markets, but to also share my views because I felt that there was a big hole in people talking to the younger everyday investors. So that's how I got here. I've known the Ritholtz crew for a while, and we always knew it would be a good match, right? We've always been good friends, and in this mutual admiration society of other people's the others' work. And I feel so lucky and fortunate that I'm here now, and I can finally represent such an amazing firm.
The I think what I found in my own path was how writing, regardless of if it's like 6 people reading it or 600 or 6,000 or whatever, like you cannot write well without understanding the topic deeply, and you
Mhm.
can't hide it. And I think sometimes that does get hidden in a little smoke and mirrors where you read a paragraph in a research note or something and it's just jargon, and
Yeah.
like you're like, okay, well maybe they either need to sound smart or they don't understand the topic enough to break it down for me to get it. And that I'd imagine starting writing at that young age makes you a much better strategist in the long run because you're forced to sit down and really break down these complexities.
That is such a good insight, and I completely agree. When I was coming out of school with a journalism degree, I actually really hated it because a journalism degree isn't super marketable when you don't have a ton of experience.
Hmm.
You become a reporter, you might work in corporate comms, you might, find your way into PR, but the possibilities, at least when I graduated, were a little bit limited. So I hated it. I felt like I was shooting my resume out of a cannon to everywhere, just trying to get a job.
Yeah.
And of course, like luckily I landed at Bloomberg, but it's really amazing to me how well journalism sets you up for a career and going deep on something. Um, the good journalists, what they do is they understand their beat inside and out. They have to. I mean, that's the way that you rise to the top of journalism, especially in the area that you focus on. You have to know the players in the game. You have to know what's going on, and you have to talk about it before anybody talk about what's going on before anybody else talks about it. And it requires you to first have these big ideas about what's going on, and second, communicate those big ideas. So now that I'm more than a decade into my career, I am so happy I took the route I did. And obviously it worked out well. I have the benefit of hindsight, but it's it's just so fortuitous to me that I kind of backdoored my way into finance because it really has helped me set myself apart from everybody else.
Yeah, and so like a little bit of a pivot, but along those lines, I think one thing that could be interesting for listeners is what advice you may have as a woman, starting out in finance in New York, navigating these different desks and these different roles, but for women who may have an interest or think they may have an interest or maybe are in the industry and not sure exactly where they want to take it, what advice, would you give them based on the experience you've had to this point?
I I have a piece of advice, but it's kind of like the anti-advice. I think I got where I think the biggest takeaway from my career and how I got to where I am is don't plan anything.
Hmm.
Um, treat your career as a jungle gym more than a ladder. And that isn't coming from me. I think Sally Krawcheck actually said that. But it's such a good analogy for how so many people view their careers and certainly how I viewed mine. It was more of a taking a step in one direction, understanding that it was the right step for the next 6 months to a year, but not being afraid to pivot and reach to the left after you've reached to the right. Just because you know that something doesn't feel right and the other side might feel better. I can't say that I planned a lot of what I did. It wasn't fully intentional. I didn't have this grand plan to become a chief market strategist after 11 years. But I asked questions. Don't be afraid to ask questions. Don't be afraid to reach out to people. Find the people that are doing what you want to be doing, and really understand what they do in their roles. Understand their parts in the industry, and how your skills could fit into that, and talk to people. This is advice for whoever you are in finance.
I agree.
I
I would,
actually,
I could use all of it myself.
yeah, yeah. But one that I want to add to is that I think one of my superhero strengths is empathy. Coming from my childhood, coming as somebody who had to or was one of the more minority populations in finance, unfortunately. I built a lot of empathy through that, and I think that that is such a strong skill. I mean, having to work your way to the top and knowing what it feels like to do that, and being able to offer that hand to others now is something that I take a lot of pride in. But I also think that it's a strength, a muscle that people can build.
Yeah, yeah. The the piece you mentioned about just like not trying to plan for what 10 years from now looks like is also like as I've been in the industry longer, like financial planning, I always say it's 90-day sprints. Like don't think any
Mhm.
further out than that because you're just gonna have a panic attack and stress yourself out. But if you know you're making the right, one or two decisions between now and 6 months from now, like the doors that you were talking about, it's funny how they tend to open. And I kind of wish I knew that earlier, but I think that's one of those things in life you sort of have to learn with time, unfortunately.
And I'm sure I have a lot more learning to do there. The way I view it is essentially how you do, Mike. It's like sowing your seeds, knowing that they'll turn into these big trees in the future, or at least putting faith in the fact that they'll turn into these big trees, and just climbing it like a jungle gym, making the best step at the time that you have, because it's really hard as a human to extrapolate 10 years into the future, 15 years into the future. You just can't do it. Nobody can.
Hmm.
Warren Buffett couldn't even do it. I'm sure there's a quote out there from him saying he couldn't. But understanding that you can't plan that far into the future, but you will eventually get there. So do the best you can right now. I think is such a skill. It's something that I've realized more and more as I've gotten older.
The other so moving from career maybe to the industry at large, let's say, in terms of the topic. So when I was moving from my prior firm to Alliance and telling other advisors or people in the industry that I wanted to work with younger people. I would get this look of confusion or uh, like that sort of this that's ridiculous. It's not going to work. So like many of my clients are like the term that I've seen thrown out there is Henry's, like the high earner, not rich yet. Um, whether they're business owners, whether they're high performers, sort of climbing the corporate ladder, the complexity ratchets up all of a sudden, at different stages in life. And, my thought was the industry is ignoring them. And I think that continues to be the case. And, you know, for obvious reasons, right? Incentives, they don't have as many assets, so you can't get paid as much. But the other side of that coin is interesting, which is like, a younger person saying like, well, why should I even work with an advisor? What's your answer to that question?
Well, as from one Henry to another, what's up? I'm in the middle of going through that too. I think you nailed it. Younger clients with fewer assets just aren't as profitable, but I think it's short-sighted to overlook our generation because we are the largest generation on earth now. We're the luckiest of us are, getting inheritance from our boomer parents to the tune of trillions of dollars in total. We are the next generation for financial advisors and RIAs. But I think what you said around them not being as profitable is what the industry really struggles with. How do we handle these clients when it just doesn't make sense financially to advise them? And they don't meet our AUM requirements, but they're shooting up pretty quickly. And from a marketing perspective, it's really smart because you have people from the cradle to the grave, the Disney, the kind of the Disney prospects of marketing. So I empathize a lot with Henrys and people in that situation because I'm a fellow Henry. And I have a lot of friends who are getting to the point where their situations are becoming more complex. They're having kids, they bought a house, they started their own business. They need to, build a trust. They need
They're
to
they're
think
moving
about
from
their
New York
estate.
to where they're back to their hometown, or they're leaving the big city. And what does that look like from an earnings perspective? Like those are
Exactly.
really complex problems to tackle alone.
Yeah, they are. It's funny you mentioned that. I went through that, but I have a lot of friends in Charlotte who went through the same thing, and they've come to me asking, "How do I figure this out?" And I'm like, "Well, on the tax side, there's a CPA. On the more holistic side, there's a financial advisor." But I think for firms right now who are struggling with their strategy around Henrys, I think the first thing, the easy day one thing you can do is start talking to them. Um, really put your value proposition out there and put it out there in a really strong and understandable way because there are a lot of, unfortunate myths and I think the role of a financial advisor is a bit misconstrued these days.
Yeah,
And,
for sure.
the firms that can stand out there and say exactly what they're doing and why it matters to these Henrys, uh, decades down the road will eventually have that strong client base.
The Along those lines, so speaking uh, about the younger investor, what are some of the things from your own life? And you mentioned a couple of them, but what are some of the things from your own life that like reflect those common themes you see among younger investors, whether in terms of behaviors and decision making, or experiences in the markets?
Wow, that is such a good question. I'll make an admission right off the bat. Matt and I don't have a will. Matt is my husband. And we just started working with an excellent financial advisor. And the first thing he said to us was, "Oh my goodness, get a will. Start thinking about
It's
your
so
estate."
common.
Even though
It's
it
so
is so common, but it's not something we talk about until it's almost too late, or you have a kid and suddenly you're like, "Wait, what happens if, God forbid, I get hit by a bus and my husband croaks too?" It's so unfortunate and it's morbid to talk about, but you have to have this kind of foresight and planning. There just aren't easy toolboxes out there to get that done.
yeah.
How I have to find a lawyer to do that. How do I even find a lawyer? How can I trust who I'm working with? There's so many questions you need to answer. So, right off the bat, I just want to make the admission that I'm trying to figure it out too, and I have a lot of friends who are in their mid to late 40s, excuse me, 30s. Wow, I'm aging myself. Mid to late 30s who are, trying to figure out the same thing. I think that this is a pretty common trend and it's a painful one. Get a financial advisor, get one you can trust. I've heard Ritholtz is really good at that.
Alliance is
Yeah,
pretty good too.
Alliance is pretty good too, but I'll throw that little I'll throw that little call in.
Um,
Um, but behaviorally, I think a lot of us are in an interesting position in that we started investing during the 2010s when the stock market felt like it just went up and up and up, and it did. There weren't many sell-offs. The ones that happened were a little more shallow. And in our work lives, we found that it was really hard to climb the corporate ladder, for lack of a better word. Our wages weren't keeping up with what our parents' generation experienced. There are a lot of us who built our wealth through equity, joining tech startups and kind of riding the wave there until the startup IPO'd or, it matured a little bit. So we find ourselves in, a much different situation than our parents, and a different situation than a lot of other generations. We also were teenagers and getting into the workforce during the financial crisis. So, a lot of us are a little more conservative, but we ultimately learned that it pays to invest because look, the market recovered from the worst possible thing you could ever imagine. So, I'm working through a lot of those behavioral tendencies as well. I like to talk about them, but I think that there's a big difference between talking about them and actually working through them. And I'm interested to see how millennials almost mature in their financial planning, knowing that all of these culture trends have kind of shaped them into what they are. The average millennial right now is, I think it's me actually, I think it's 33. And we're at the point where we're, getting married, having babies, buying houses. We're like this big demographic wave. And I'm excited to see how these behavioral tendencies, work their way into markets and how we view money.
I think there's there's an interesting like dichotomy that you hit on there if you're talking about this millennial, I guess, experience since the global financial crisis, where markets essentially went straight up, right? With a few pullbacks along the way. Obviously, you had an era of low interest rates where people don't know anything else in terms of the cost of capital until recently, and that's sort of like one side. But then you have that struggle and that scarcity in terms of wage growth. And how do I put this away? Where does what should the rainy day look like, and how much should be in the market? And those two things seem to be a common like push and pull of yes, like I know these things over here, but also like I need to buy a house and they're way more expensive than they were even 5 years ago. And I don't know how that plays itself out over maybe the next 5 years, but I think that's where a lot of people are sort of stuck. I don't want to say between a rock and a hard place, but they're balancing those things in their head.
I think you nailed it there. And I love that you brought up interest rates too, because I don't know about you, but I was raised in a household that hated debt. Debt was the evil of all evils, and in the 2010s, it actually made sense to take out debt. You had S&P returns of 10+% on an annual basis, and you had interest rates. You had mortgages around 3 to 4%, and even lower in the 2020s. And that's a big psychological barrier you have to work through, right? Debt can be a tool if you use it correctly, and some types of debt are harder to manage than others. But in the 2010s, a lot of debt was a tool, and we had to work through this stigma of taking on debt, and how bad it is for our financial picture. Except it actually isn't bad, when interest rates are as low as they are.
Yeah. And then you have obviously the student debt variable, which is
Mhm.
something that kind of like just crept up along the way with it became normalized. I guess sort of like low interest rates did. It became normalized, and then all of a sudden when that paradigm shifts, it's like wow, maybe that wasn't so normal.
Yeah. And I think all this conversation just goes to show you that finance really evolves generation by generation. I can only speak for millennials because I am one, but I can imagine like the Great Depression really affecting our grandparents, World War II affecting our parents and our grandparents. These big events in society, for lack of a better word, just really shaping how we think about money and how we approach our finances. And even more so how it bleeds into financial markets, how it shows up in behavior and market moves and market preferences. I mean, crypto, I know people love to hate to talk about crypto, but I think crypto exists because millennials and younger investors are dealing with this conflict between prices getting really, really high on homes and not being able to really keep up with it in that traditional job. There's a lot of distrust in the system right now. But I'll put it on the table right now. I'm crypto curious. I'm not one of those raging crypto
That's
bulls,
I might steal
but I
that
think
term.
the space is really interesting. So, to be clear, I'm a realist here. But I think you have to acknowledge that it exists because there is something that people see as broken in the traditional system. It just hasn't worked.
And saying, I don't think as an industry or as an advisor, on a go forward basis, saying, well, we don't do that, or I don't know what that is, or I don't believe in it. I don't think that's going to be a good enough answer, regardless of the outcome.
No, especially when you consider that over half of investors 44 and younger hold crypto in some
Well, I
form or
never heard that.
facility.
I never heard that stat.
Yeah, so at my former role, I used to work at eToro, which is it's a big global brokerage, very popular in Europe, but it was built on this belief that you should provide tools to investors to invest. They make the best decisions with their own money. We give them all the tools they need to make those decisions. And crypto was one thing that we believed in from the start. And so I was talking about crypto a lot, and we would do all this research. We did a quarterly survey called the Retail Investors Beat Survey on it, and consistently we saw that younger investors held crypto at a much higher rate than older investors. Makes a lot of sense, but these are future clients for financial advisors, and they're probably going to be holding some type of crypto where their plans have changed, and they're going to be asking you what to do with it, what makes sense. And you're going to have to answer those questions. You can't just dodge it.
Yeah, yeah. I think one thing that we talked about before in terms of the writing and why I reached out to you was at Alliance. A lot of our writing, I think, is it's trying to identify things that don't change a whole lot. Whether it's a market cycle, the human psychology, debt cycles, just to name a few. But we write these foundations pieces, we call them, and we try to identify these and let those be guardrails, or so to speak, to allow you to make better decisions, sort of regardless of the environment, because these things generally hold true over longer periods of time. And one of the lines I really loved in your recent analysis that I think like fits with that was that it's very expensive to miss out on a bull market. And history has consistently shown that to be the case, but there's always a reason to sort of not believe in it. So you talked about this on your spot on CNBC last week, but talk about, regardless of where the market is today, tomorrow, where it'll be a year from now, why is it expensive to miss out on these bull markets? And maybe even first, what did you mean by that specifically for somebody who's not, an investor or, following the markets day to day?
Down even more than that and talk about what a bull market is because if I talked
Great
to my
point.
mom today, she'd probably say I don't know what a bull market is. She doesn't work in finance. So when we talk about bull and bear markets, stocks. So we'll start with this. Stocks usually go up over time. History has shown us again and again. If you invest in U.S. stocks broadly, I'm talking about the S&P 500. Um, Stocks have gone up over time with quick sell-offs here and there. Typically, when stocks drop 20% or more, that's a big sell-off, a market crash, if you will. That's called a bear market. And I can get into the bull and bear analogy because that's quite interesting too. But whenever stocks aren't in a bear market, when they're rebounding, when they're rising, and from a technical perspective, when they rally 20% or more from a 52-week low, they're in a bull market. So 80% of the time, I believe since 1950, we've been in bull markets. Stocks have gone up more than they've gone down over time. And the confusing part about that is when people invest, it's not as easy as stocks are going up and they will go up, so I'm putting my money in the market, right? Emotionally, it's a lot more complex than that. You're dealing with all these conflicting headlines and pieces of data and media sources screaming at you about how terrible things are. That's something that's never changed throughout history. We've As
we've just found new ways to do it.
in society, we've gone through some pretty terrible crises, but humans are really good at powering through those crises, and necessity is the mother of invention. So why I'm saying this is because it's so important to realize as an investor that this is your greatest tool if you're able to think years and decades down the road. If stocks usually go up, then what you have to do on a very basic level is stay invested and weather those sell-offs when things feel terrible. And why it's expensive to miss a bull market now is, quite frankly, we're in a bull market. Stocks have been going up for the most part since October of 2022. That's when they distinctly stopped going down as much and started going up more. And as you know, it probably doesn't feel great to invest right now. We have headlines around the election. We have headlines around inflation and how it's still pernicious and showing up in our daily lives. We have headlines around the job market and some layoffs happening in certain sectors. But the truth is, stocks are moving higher. The S&P is up, I believe, 15% this year. And if you want to doubt a bull market, if you cling on to one of those headlines or cling onto one of those stories and say, I don't believe this, stocks are going to crash soon, sticking to that belief can be really expensive over time because as you wait and stocks keep going higher, it gets more and more expensive to buy in. So I'll throw a stat at you. The average bull market since 1950, so over the past 7 decades, the average bull market has lasted about 5.5 years. This bull market is almost 2 years old. It'll be 2 years old in October if it lasts that long. But bull markets go up really fast. I mean, the average annual gain in a bull market is about 20% over these past 7 decades. That's a lot to miss out on if you don't believe in the market, if you tell yourself that you can invest in tomorrow instead of today. Time is your greatest asset as an everyday investor. A lot of us have loads of time because we're investing for retirement or we're investing for that beach house that we want to own down the road. So take advantage of that. Understand that stocks usually go up over time, and compounding and just those gains, building on gains, is your biggest asset.
And it's amazing. I think that when we show different charts or things during meetings, like the fact that 80% of the time we're in a bull market, like that usually, I don't want to say it shocks people, but it surprises people, I think, because of the information overload you're getting. And then you zoom out and then all of a sudden like, oh, wait, like you see the light bulb go off when you're able to zoom out. But a question I had along those lines, do you think the urge to stay on the sidelines today is like the gravitational pull to the sidelines is stronger because for the first time, and we were mentioning it before, for the first time since 2008, or before that, you're making 5% on your cash, you're making a little more on bonds, and with the amount of sort of anxiety out there based on what you read in the news or what you see on social media or what you see in terms of the politics going on, both home and abroad, that gravitational pull to that 5% cash, sort of regardless of the investor's age, seems to be getting stronger. And I worry that people are falling in love with that to a certain degree at their own detriment.
I agree, and I think this is one of the biggest stories in in markets right now that not enough people are covering. So I saw this survey from Merrill Lynch. I think it came out last week. It was a survey of their high net worth clients, and it was all about how are you investing? What do you think about recent developments in the economy, recent developments in the world, and how are you responding to that? Essentially, also how do you use financial advisors? Just chock full of interesting insights. But one thing that caught my eye, and uh, honestly, I saw it in the report and I shrieked a little bit, was this question around cash. I think the question was, how have your cash levels changed over the past 2 years or so, just
Okay.
over like a few years time frame? And the question split out the answers between younger investors, I think it was 45 and younger, and then older than 45. And younger investors, 45 and younger, actually built their cash up at a higher rate than older investors did, which is the exact opposite of what you'd
Yeah,
expect.
yeah.
You get into less risky investments as you get older. Isn't that like the basis of financial planning, right? So that was shocking to me. And I do think that a lot of investors are falling into this trap of getting lured into that 5% savings rate, which is a great rate. And like, let me just be clear, if you're saving cash, you're doing better than the majority of Americans right now. So, be proud of yourself, but understand that there is so much more you can do, especially if you are younger and you have time on your side to invest. I'm actually releasing some thoughts about this later this week. I wrote a whole post on it. It's more like a rant. The millennial woman yells at a cloud, but um, opportunity costs exist. If you sat in that 5% rate when the Fed last raised rates, if you sat in that, you're probably getting up to the 4 to 5% return, but the S&P has been up 20%
Yeah.
since then. The Nasdaq's been up 30% since then. Of course, you're taking on more risk, but over time, that risk more often than not has paid off. And when you're younger, you have to take on some risk to build that wealth. I mean, we all learned that from Warren Buffett, right? So I think that this is a problem, for a lack of a better phrase, because on a basic level, it's not a problem. But I think that a lot of investors are trying to be opportunistic with savings rates when they can be much more opportunistic in financial markets and riskier assets.
I think where the planning comes uh, in this conversation and in this environment is like, if you can just sort of cut off a sleeve of those preservation assets, whether it's cash, or a combination of cash and bonds, that just lets your head hit the pillow and insulates you, that opportunity cost isn't given up. And so, like,
Mm.
what do those buckets look like? It's different for everybody, but cash plays a role. And I don't think anyone would say it doesn't, right? You need that buffer and you need that liquidity, but it can't be, you can't go overboard with it.
Exactly right. And I think that's the line. Saving as much as what makes you feel comfortable enough to sleep at night. Um, for some people, that's 3 months of expenses in an emergency fund. For others, it's 6 months of expenses in an emergency fund. Some people are saving for a house, so maybe it looks even bigger than that. But knowing where the line is for you and understanding that to really build wealth, to really reach these lofty goals that many of us have, you have to be invested in the stock market. The S&P has returned 8% uh, on average annually over the past 20 years, I think it is. Um, Cash hasn't returned nearly as much. And historically, you could tell the same story over and over
hmm
again. So to get those strong growth rates, to build your portfolio into the millions, you have to take some risks.
So let's kind of double click on the risks, because I think, like, believing in bull markets was your line that I loved, and how expensive it is to miss out on that. But you had mentioned in that interview on CNBC too, like, we can't be blind to these risks, like, they exist. So talk about some of the risks you see out there, and how can investors, regardless of their age, how can they make those risks more tolerable?
Yeah, investing isn't a zero sum game, and we like to make things zero sum all the time. But you usually, when people invest, they're not scared and completely in cash, and they're not, you know, fired up about the future and completely in equities. And I think that's important to understand. As we navigate an environment like this, you don't have to be all in or all out. You can be a little bit in and, still be a little nervous and understand that sell-offs can happen. 5 to 10% sell-offs are actually quite normal, even when, we're in a bull market and stocks move up. There are blips where prices fall. Um, some of the risks right now, of course, we're in an economy that has a lot of pressure on it. Interest rates are the highest they've been in about 15 years or so. And that's great if you're a saver, like we just talked about. You're getting a 5% savings rate, hopefully, on your cash sitting at a bank. But at the same time, that means that you have to pay more to borrow money, and it's you and it's corporate America that's paying more, and that weighs on profits. It's just a much more tenuous situation. Luckily, the economy is weathering it well, but growth is slowing down. Companies are hiring less. Inflation is coming under control, but at the expense of consumer confidence and this excitement about the future. So, a big risk that I think about is, what's breaking underneath the surface. What is going horribly wrong because interest rates are this high that we just don't know about yet. And I'm not saying this is happening, but I think that's a worry of every Wall Street strategist right now is, we've been in this high rate environment for so long. What are we missing? It can't be going this well, right? I think that there are a lot of risks sitting on the horizon that are a little more known. I think the election could cause some, back and forth in markets, especially as we, understand what the stakes are getting closer to November. The Fed, obviously, the Fed is the one who controls the lever on interest rates. They've all but hinted to us that they're going to cut rates in the future. But what's the context in which they cut rates? Is it because the economy is crashing and they need to yank the lever back, or is it because they're happy with how things are going and they think they can let up on the brake a little bit? Um, I think you can sum it up this way, Mike. We're in an environment where the economy is growing. It's growing at a slower rate, but it's still growing. And that's, bar none, a good time to invest. The problem is there's a lot of this context that we've never seen before, and we're all trying to digest how it'll affect companies and Americans and how they think about money. And there's a chance something goes wrong there. There's a chance that we're missing something, or there's a chance that the economy is slowing a little bit more than we thought. But what you have to do is kind of take the data at face value, understand your time frame of investing. If we sell off starting today, how long can you wait for that sell off to recover? And then, just broadly understanding why you're doing this whole thing, right? If you're investing for retirement, if prices sell off right now, it's probably good to have a plan to understand, where you can step in and boldly invest some cash, knowing that you won't have to take it out for decades.
Yeah. The having that uh, sort of regimented approach prior to it happening is the key there, right? Like you're not going to put together the plan when we are at the bottom, right? When we are when we have sold off 20%. But I think your point as to all of these variables that Wall Street analysts and the strategists and the economic forecasters are trying to constantly predict. I mean, people have been predicting recessions for a few years now, and that's just sort of like the latest uh, sort of miss uh, of the so-called experts. And but like clearly there is a market for predictions because Wall Street will not stop making them, even though they're always wrong. And I think what I always enjoyed about both your work and the people at Ritholtz who I read all the time is how comfortable they are and how comfortable generally like the best investors are at saying, I don't know what's going to happen next, but we are ready for a wide range of outcomes. And I think that's how, that's our philosophy at Alliance. But what is that? What is the need for predictions? Uh, Whether it's, investors who crave it or Wall Street who won't stop pumping them out.
It's certainty. We all crave certainty, right? As humans, stepping forward each day in this weird thing we call life. We all want some kind of certainty. We want some dependency in the future. But frankly, nobody can give you that. Nobody knows what the future holds. And yes, Wall Street strategists commonly put out S&P targets. They usually do that by running, earnings estimates and inflation rates and interest rates through models and saying, okay, based on what we expect for all of these variables, this is probably where the S&P 500 will end. And those make headlines, right? Again, everybody wants certainty. So if you're willing to step out and say something like that, the news will probably cover you. But it's all a marketing machine. And any strategist will tell you that if you see him at a happy hour, they wouldn't say it
I was
publicly.
just going to say, most of them don't say it with the microphone next to their face like you just did.
Right, but it really is a marketing machine.
Yeah.
A lot of those strategists are writing for institutional clients, and institutional clients just want the data. Um, But who I'm talking to right now is probably isn't an institutional client. If you're like me and you're just investing for retirement, predictions are probably more detrimental than they are helpful
Yeah.
because nobody knows what the future holds and you can't invest based on a prediction. That's a recipe for failure. So, yeah, I feel really comfortable saying I don't know what's going on. I got a crystal ball, but it's broken and will probably never work again. Nobody has a crystal ball. But this is something that you have to accept when you're an investor. the price of returns and reward down the road is accepting this uncertainty of not knowing what the future holds, but putting it out there in faith that you believe that the economy will keep growing over time, that society can overcome these challenges, and that, if you're a single stock investor, the company that you're investing in has enough going for it that it can, build the best product on the market, for example. So I think there's some power in saying, I don't know. I think you need to do it as an investor from the outset, and you have to shut out the noise, these predictions that you're hearing, because they're not for you. They're just not for you. And 90% of headlines that come across the tape aren't important to the people just investing for years and decades down the road.
The one of our foundations is there's no such thing as a free lunch, and you can view that
Uh-huh.
both on the product side. Oh, this guaranteed return annuity, da 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 da. Like, yeah, that's probably not no fee. Somebody's getting paid, but I view it more in like you cannot say you want to get those returns to build the life you're aiming to build without feeling uncomfortable along the way. And that goes for anything in life, but it certainly applies to markets.
Yeah, absolutely. And you're right. It applies to anything. There was a saying that one of my former bosses told me, and I thought it was so wise. It was something about, if you feel uncomfortable, you're doing the right thing.
Hmm.
Growth takes sitting in these like liminal, uncomfortable spaces and just having to endure it, and then coming out on the other side and realizing what you learned. So I think that's definitely true in markets. It's true in life, and it's a thread that I think everybody realizes kind of pulls through their day to day. When they take a look back.
Yeah, I like that. I like that. Just listening to it and following it, probably going to take you to a better place in the long run, right?
Yeah.
So wrapping up here, I have two more questions for you, and I'm hoping we can put this up on the slide when we publish the episode. But at the very least, we're going to put it in the show notes so people can look at it while you're talking about it. But one of the pieces you wrote, and I think it wasn't even a full article. I don't think it was just a sort of a visual with your description and analysis of it. But it was workers versus owners. And I think it perfectly shows a lot of the things we talked about over the last whatever amount of time it's been. But can you talk about how this concept applies to everyone, not just business owners, and why it's so important for people to understand?
Like we said, it's the bane of millennials' existences right now. So, and I hope you can put the chart up because I think the visual explains it well. But over history, and we have data on this, right? The government releases monthly data on wage growth. They break it down into income quartiles, so lowest income, lowest quartile versus highest quartile. Trying to show some semblance of upper class wage growth versus lower class wage growth. That's a lot of detail, but what I want you to know is, we have this data on wage growth over time, and obviously we have data on how the stock market has done over time too. And if you stack wage growth, i.e., the bump you get in your paycheck every year versus what you see happening in the stock market outpaces wage growth just incredibly over the past few decades. And if you take a look at the stock market, it makes a lot of sense. The stock market has done really well. Wage growth has stagnated. There are a lot of companies that are more interested in investing in financial efficiency than they are their own workers. It sucks, but that's just the way it is. And for you as an investor, you control what you can control, right? So you need to be an owner. I'm sure everybody has heard somebody say this in some kind of context, but when it comes to investing, you need to think like an owner. If you invest in a company, you are essentially privileged to their profits. That is the basis of investing, and you know, you as an investor can participate in these like wild financial efficiency gains that these companies are going through and not necessarily passing along to their workers. Um, Wage gains and stock market gains were a lot more correlated back in the 60s and 70s and 80s, kind of before Wall Street took off and started, scheming about how to, make more money out of money, right?
Yeah.
But that's just not the case anymore. And it's so important to become an owner in these markets, in this economy. The way that you do that is you invest. There are other ways too, like taking some of your compensation in equity, which, by the way, is not a recommendation, but it's just another way to become an owner. Buying real estate, again, not a recommendation, but a way to really control the cash flow of the assets you own. But think about becoming an owner, because working for wealth doesn't work anymore. It hasn't worked for decades. So this thought of being able to climb the corporate ladder that, of course, we as millennials had instilled in our brains, that's in the past now. You have to think differently if you want to build your wealth down the road.
Yeah. So good. I mean, we talk about it every day, but when I saw that post and that visual, like it was like, aha, like this is what we've been trying to articulate and doing it poorly. And she just unlocked it for us.
Oh, that's so kind. That's so kind. But when I made that chart, I think I was doing a kind of a data dig on income inequality for a friend of mine who was writing a newsletter. And I was like, you know what? I just have to look at this, wages versus stock prices, because the story of the 2010s was markets went up, but everything got more expensive
Yeah.
and we
Like we
felt
were
like we
talking
couldn't
about.
keep
Right.
up.
Yeah.
Yeah, exactly. And the data shows that too. And, it requires a different mindset. Hopefully things become a little more balanced, but you can't depend on that. You have to do what you can do today.
So the last question I have for you, and then I want to talk about your new newsletter, so people can follow you. But this is a question I've asked every guest on the podcast so far. But knowing all that you know now and everything you've experienced up to this point in your life, what advice would you give to your 22-year-old self?
Wow, this is such a good question, and it's going to be very personal for me. So I'm not saying this advice works for everybody, but I've always struggled with confidence, um, especially in my early 20s, getting into my career, trying to navigate, a wild, changing world of media, and then getting into research. I've always had a lot of imposter syndrome. Even though, I'm one of the hardest workers in the game, I will dig data for hours and I'll make sure that I have the best argument of everybody. That's been the case forever. So, if I could talk to my 22-year-old self, I'd probably tell her to be more confident. Understand that you have a lot to offer in this world. Many of us do. And, those skills that are special to you, can really help a business, can help somebody else understand a world that you understand better than anybody else. Just be more confident in what you have to offer.
That's so good. Yeah, that's a good one. So tell listeners, where can they find you? Where can they follow you? And how can they read your stuff now that you've landed in your new gig?
Yeah, it's different. So I'm at Ritholtz now. I'm the chief market strategist there. So at the moment, you could probably see me in media. I'm talking media quite a bit, but I just launched a newsletter called Cautiously Optimistic. It's on Beehive. Hopefully Mike will throw this in the show notes, but it's Wall Street quality research written for the rest of us. Everything we talked about, Mike, these are the types of topics that'll land in the newsletter. And my goal is to write exactly how I talk here, breaking it down for everybody, giving you the insights that you as an everyday investor need, cutting out the fire hose of BS that you have to trudge through in a lot of these research services that are out there right now. Talking about what really matters in markets and teaching you about, how the stock market works and how your brain works, more importantly, when it comes to investing. So cautiously optimistic. I'm going to write a new post every Monday. First post is coming out later this week. I'm also on Twitter, or X. It will always be Twitter to me, but
Same here. I can't
yeah,
I can't
yeah.
make the
Um,
adjustment.
no, I will never make it. I'm definitely stuck in my ways there. I'm on Twitter at Callie A Bost, CALLIEBOST. Wait, CALLIEABOST. And then I'm on LinkedIn. I share insights on both.
Great. And so I just, as somebody who I shared with you my newsletter, and I try to write every week and put something out there for clients that's useful, that's interesting, that's entertaining. And so, needless to say, I don't do it at the scale you do, but I know certainly how hard it is. So, one, thank you for all the good stuff you've put out there, because I know us at Alliance have enjoyed it and benefited from it, as have our clients. But wish you nothing but the best in this new role, and look forward to see what comes next for you.
Thanks for having me. This was so much fun, and I just talk about markets all day. I have one of the best jobs in the world, so I'm really excited to see where it goes.
Thanks, Callie. The information in this interview is provided for informational purposes only and should not be taken as investment, legal, or tax advice. Opinions expressed in this interview are subject to change without notice. It is important to remember that investments in securities involve risk, including the potential loss of principal invested. Past performance is no guarantee of future results, and diversification does not guarantee a profit or protect against loss in a declining financial market. Alliance Wealth Advisors is an investment advisory firm that is independently owned and operated. Alliance does not make any representations as to the accuracy, timeliness, suitability, completeness, or relevance of any information prepared by an unaffiliated third party mentioned in this communication, and takes no responsibility. Our guest did not receive any compensation for this interview, is not affiliated, and not a client of Alliance Wealth Advisors at the time of this publication. For more information regarding Alliance, please visit alliancewealthadvisors.com/legal disclosures.